This accounting mini lecture covers inventory costing using the average cost approach. Now, as we can see here in this chart, there are a number of companies that use the weighted average approach. Based on this particular study, roughly 1 in 5 use the weighted average approach. So that's what we're going to examine. Now, as we learned in our video for the FIFO method, using the FIFO method, we assign the first cost incurred to cost of goods sold. Under the LIFO method, we assign the most recent cost to cost of goods sold. Under the weighted average approach, we use somewhat of a meet in the middle method. We compute the average cost of goods on hand at the time, and that's what we assign to cost of goods sold. So we're going to look at an example. Now, this is the same example that we used for the FIFO and LIFO video as well. So we're looking at the same basic transactions. We start with the beginning inventory balance. We make a purchase, then we make a sale, we make 2 additional purchases here, and then we make a final sale. So let's look at how our approach will differ from what we saw with FIFO and LIFO. Okay? When we use a weighted average approach, every time a unit is sold, we have to compute our average cost per unit of inventory that we have on hand. So, in this particular example, remember we started with our beginning inventory. We had 10 units at $91. Then on August the 3rd, we purchased 15 additional units at $106. So what we're going to do at this point is compute the average cost per unit. In this case, we take the total cost and the total units, and we have 25 units at a total cost of $2,500. Therefore, the average cost per unit is $100 per unit. So when we make a sale on August 14th, that's the cost that we're going to assign to cost of goods sold. It's not going to be the $91 or the $106. It's going to be that average cost per unit of $100. On the 17th and the 28th, we make additional purchases. Therefore, when we make our sale on August the 28th, we have to compute the average cost per unit. In this case, based on the inventory that we still have on hand, our average cost per unit is $114. Therefore, that's the amount that we are going to assign to cost of goods sold. The 23 units will go into cost of goods sold at $114 per unit. The number of units remaining in our ending inventory is also going to be listed at $114 per unit. Now, let's look at the impact to the income statement and the balance sheet. And we've done this for each of the approaches for FIFO and LIFO, and now we see what it looks like using the weighted average method. You can see that our cost of goods sold amount goes under the sales. We use that to compute the gross profit. And that, of course, also impacts our net income because you remember, cost of goods sold is considered an expense on the income statement. Our inventory balance, remember this is going to be a current asset on the balance sheet. But here we can see how each approach gave us different totals to be used on the income statement as well as the balance sheet. Thank you for watching this presentation on inventory costing using the average cost approach.